if we look at the sector that Pivo is focused on, we're focused on, number one, the digital banking sector. We're also focused on the credit/loan space. The difference between our approach is our credit/loan product is centered around supply chain finance, with a focus, of course, on the supply chain sector and different value chains across, a company's or a country's supply chain space. Some of the trends that we're seeing in the supply chain space and specific to supply chain finance is that there is a lot of push towards how a lot of businesses, whether commercial banks or microfinance banks, can solve the credit gap for SMEs using a supply chain finance model, right? Now, a supply chain finance model is one that ties the issuing of loans against an SME's receivables outstanding or against an SME's receivables upcoming, right? And being able to sort of like use that model and rely on the supply chain to implement that model is becoming a lot easier, because in the supply chain space now, there's a lot of engaging or implementation of technology across different spaces in the value chain, right? So whether it's technology that allows you to place and manage orders, whether it's technology that provides for visibility, whether it's technology that allows for like e-invoicing or managing accounts and managing payments, there's a lot of technology that is being implemented in supply chains now. And what that essentially means is that if you're launching or building out a supply chain finance program for SMEs, it's a lot easier to integrate across each of these different sorts of buckets with larger corporations, right? That can help with making like informed credit decisions that can allow for things like ensuring that repayments are made against sort of like loans that are issued out and things like that. So yeah, I guess a lot of things that we're seeing is an increased adoption of technology in supply chain, an increased use of supply chain finance as an approach or as a program for lending to SMEs in the space. It's something that the traditional banks are doing, but they are doing it with an approach and with a focus on larger corporates, with a focus on larger companies, larger businesses, right? But what Pivo is doing is we're using or we're implementing supply chain finance from the approach of SMEs, right? So why a larger business or a larger bank wouldn't like touch the SMEs is because to them, most of these SMEs do not have that credit profile, do not have that transaction history that allows banks to either credit profile or risk assess their loan portfolio, right? But with Pivo, what we've seen is that we can focus on SMEs, but we can zoom out and attach the credit profiling and the risk assessing to the larger corporate that these SMEs are working with, right? So what that then means is decisions that we make around the SME that we're financing is tied to the larger corporate that they're doing the business with, right? So yeah, that's sort of like where our differentiating factor comes in.